All right, let's dive in. Today, we're going to crack the code on one of the most critical and honestly, one of the most confusing documents in all of business. It really all boils down to one simple question. Where did a company's money actually go?
It's the classic business mystery, right? You see a company reporting these amazing, record-breaking profits, and then suddenly they can't pay their suppliers, they can't make payroll. How does that even happen? Well, the answer's all about the gap between looking good on paper and having actual cold, hard cash in the bank.
And this is the tool that solves the mystery. The cash flow statement is kind of like a financial detective. It doesn't really care about fancy accounting theories. Nope. It just follows the money. It tracks every single dollar that comes in and every single dollar that goes out. It gives us the real story of a company's financial health, and it breaks that story down into three main parts.
So let's start with the first and definitely the trickiest piece of this puzzle, operating activities. This part is supposed to tell us how much cash a company is making from its main, day-to-day business. But to get to that true number, we first have to peel back some layers and undo a few specific accounting adjustments.
Let's jump right in with a weird one, goodwill. Okay, so if a company's goodwill on the books goes down, that's called amortization. It's treated as a non-cash expense, so we actually add it back to the profit right here in the operating section. But if goodwill goes up because the company bought another business, the cash they spent shows up in a completely different section, investing. So you've got the same line item treated in two totally different ways. It all depends on which way it's going.
Oh, and taxes? Yeah, they're another huge stumbling block for a lot of people. The secret here is to separate what's just an accounting entry from what's an actual cash payment. That provision for tax you see, that's just the company setting aside an amount on paper. No cash has actually left the building. But the line for income tax paid, that's real money that has left the bank account. So that's a true cash outflow from operations. The other two items on this table, they're basically just clues to help you figure out those main numbers if they aren't listed clearly.
And the adjustments just keep coming. We add back things like provisions for doubtful debts because, again, it's just an accounting entry. No cash has actually been lost yet. Then we do something that seems a little backwards. We subtract interest received and add back interest paid. Why? Well, think of it like this. We're sorting cash into the right buckets. That interest is real cash, for sure, but accounting rules say it belongs in the investing and financing sections. So we take it out of here to put it where it belongs later. And when it comes to dividends, we only care about what was actually paid. A proposed dividend for this year is just a plan. It hasn't hit the bank account, so for now, we just ignore it.
So look, here's a simple way to think about this entire section. The whole point is to reverse any accounting entry that didn't involve a real cash transaction. If you're ever stuck, just ask yourself, did money physically leave the company's bank account? If the answer is no, it's probably one of these adjustments we're talking about. This whole process is designed to get us back to the most important number, the true, unvarnished cash-generating power of the business.
All right, that brings us to the second part of our story, the investing activities trail. Now, the good news is this section is way more straightforward. It's just tracking the cash a company spent buying or earned from selling its big long-term assets. We're talking things like property, equipment, or even buying other companies. So, buying a new factory, that's a cash outflow. Selling off some old machinery, that's a cash inflow. Simple as that. And hey, remember that interest and dividends received we took out of the last section? Well, here's where they find their home. This part of the statement tells you where a company is placing its big bets for the future. A big negative number here isn't automatically a bad thing. It could just mean the company is investing heavily in growth. But a big positive number, that could mean it's selling off assets to raise cash, which might be a bit of a red flag.
And finally, we get to the financing activities blueprint. This section follows the flow of money between a company and its owners and its lenders. It's all about how the company gets the cash to run the business and how it gives it back.
And here are the usual suspects. Taking out a loan brings cash in. Paying back that loan, or paying out dividends to your shareholders, sends cash out. Ultimately, this section answers a really important strategic question. How is this company funding itself? Is it taking on a lot of debt, or is it funded by its owners? This tells you a ton about the financial risk the company is carrying.
Now pay attention, because here's a pro tip that catches so many people. Things like short-term loans, using a cash credit line, or a bank overdraft. They feel like part of the daily operations, right? But in the world of cash flow accounting, they are always considered financing activities. Why? Because they're methods of funding the business, not part of the core business itself. Big difference.
Okay, deep breath. We've solved the three individual puzzles. We've gone through operating, investing, and financing. Now it's time to put all those pieces together and see the final, complete picture of the company's cash story for the year.
And the final calculation is actually pretty simple. You just take the net cash flow from each of the 3 sections we just covered and you add them all up. That gives you the total change in cash for the period, whether it went up or down. Then you add that number to the cash balance the company started with, and it should perfectly match the cash balance at the end of the year. It's the ultimate proof that every single dollar has been accounted for.
But wait, just when you think it's all wrapped up, there is one last, absolutely crucial exception. And you can tell how important it is by how the source material puts it, with 4 onlys. That's not a typo. It's for emphasis. It's telling us that for certain things, some very liquid investments aren't treated as investments at all. They're treated as cash itself.
And this is exactly why the statement is officially called the Statement of Cash and Cash Equivalents. What are cash equivalents? Well, they're things like short-term investments or marketable securities that are so safe and so easy to sell that you can turn them into cash almost instantly. They're as good as cash. So when we're calculating that final closing balance, we lump these right in with the actual cash in the bank.
So there you have it. You now have the tools to crack the code. You can look right past that flashy profit number and see what's really happening with a company's cash. So the next time you look at a financial statement, you can ask the real question: what story is the money actually telling?